Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 330th VideoCast podcast for the week ending February 12th, 2026. We got a lot of great stuff to cover today, but as always, family first. This was Annabelle playing Zeus in her school play, but more importantly than that, she had one of the most exciting days of her life, according to her, and I'm going to play it for you now.
Okay, I got the blind bag Chick-fil-A cup, so I really hope I'm gonna get the golden. Let's open the first one. No, I did not get the golden. It's okay. Okay, I got like this one. Like it's like the regular one, the brick one. But it's really pretty. It's like really good, like feel. It's like really good.
Oh, nice.
Yeah. Okay. One more. Okay, this one is the lemon one. I love these little cookies. Okay. 3, 2, 1. Oh my God! I got the golden! I got the golden! Oh my God! Oh my God! Oh my God! Oh my God! I got the golden! Oh my God! Oh my God!
So Annabelle will be getting free Chick-fil-A for the next year. Breakfast of Champions. She is a super fan of Chick-fil-A, so that was a serious day. What are the odds? No idea, but congratulations. You scored the Golden Fan Cup, and that's a special thing, and she's excited. I got to speak to an incredible group of students. Thanks to Professor Shepard for having me to his class at USC, the Trojans Marshall School of Business. We're going to cover that next week. We're going to have the full lecture and Q&A as part of our podcast, where I lay out in detail our entire investing framework. You do not want to miss that. It's going to be amazing. Okay, that's me with the Trojans. And that's Annabelle with the manager of the store of Chick-fil-A. He couldn't believe it either. And everyone was super duper excited. Okay, moving on. Here's Caitlin and Annabelle and I at the Super Bowl party this weekend. Good for Seattle. Then on Friday, I got to shoot down to the Phoenix Waste Management Open. Thanks so much to my friend Marcus R. You know who you are, and the incredible box we had right on the 16th hole tee. It doesn't get any better than that. Incredible time. Met a number of his friends, John, etc. Super time. In and out in a day. It was just phenomenal. And then that's it for all of the family updates. And now we're going to get down to business. I had the pleasure to join Varney and Co. on Fox Business on Friday with Ash Webster. Thanks to Maggie Edwards for having me on. We're going to listen in here.
Slightly lower in the pre-market. Thomas Hayes joins me now. Thomas, okay, well, any of these reports, I'm sure the CPI probably the biggest with regard to the Fed, but could any of these reports derail the rally that we saw Friday?
I think we're in good shape here, Ash. The broadening theme is well intact. We saw that on Friday. That 1,200-point gain was predominantly Caterpillar and Goldman Sachs, while Amazon was down 5.5%, Google was down 2.5%. And as it relates to the consumer sentiment has been at record lows. It is now at 6-month highs. We saw the most recent reading. The consumer is building confidence. Not only is sentiment going up, which is very good for the market, inflation expectations are at a 1-year low. That's going to give people confidence to go out and spend. You're seeing 75% of companies reporting a rise in profits. That's up from 55%. That's the highest since 2021. And the final bit of good news is that broadening is very, very healthy for the economy. Equal weight indexes are outperforming the cap weight, the S&P 500, by 4.2% year to date. So it shows Main Street, real economy, real businesses doing well, not just driven narrowly by a few stocks.
Well, diversification, always a big key. By the way, look, AI wiped out $400 billion in market cap last week. Does that give you pause, the power that holds and what it can do to the market?
Well, this has been a theme for 6 months that we've been talking to the audience about. It is playing out in spades. Yeah. It's actually a sign of health, okay? What we see, first and foremost, is CapEx is going up. CapEx as a percentage of operating cash flow for the Mag 7 is now 60% in line with the oil sector. So the market doesn't really like that. Earnings growth is going down. So what are investors doing? They're saying, where is earnings growth going up and where are multiples reasonable? And what we see in easing cycles is actually the top 3 performers are healthcare, staples, and REITs. And that's certainly been the case year to date.
Very good, Thomas. Lots to get to today. Thank you so much, sir, for joining us, though, on this Monday. Do appreciate it. Now.
And we're back. And now I want to go through some chart data, just to kind of kick us off. Our quote of the week, of course, as Buffett would always say, investors should remember that their scorecard is not computed by using Olympic diving methods. Degree of difficulty doesn't count, AKA you don't have to predict the future, wait for the fat pitch, and then stick with it through the short-term noise for the long-term benefits. That's what we do here at Hedge Fund Tips with Tom Hayes. Second, what counts for most people in investing is not how much they know, but rather realistically, they define what they don't know, which is why we tend to avoid software companies at Great Hill Capital and Hedge Fund Tips with Tom Hayes, because it's very hard to understand the moat and whether or not it can be breached. And that's one of the reasons Buffett avoided it throughout his career and did quite well buying boring, durable, predictable businesses. Also want to acknowledge Justin H. for sending in his picture with his Hedge Fund Tips hat. I want to thank everyone who's participated. You can just see pictures upon pictures. We're building an incredible community here. If you're getting value, and it's amazing to hear the stories from the students, from people emailing in, etc. All we ask is share it with one person you care about that could benefit from this information. Easiest way to do it, wear a hat, wear a hoodie. People will ask you, and you can share the good news there. Let's get down to it, get a sense of where the market is. And we're going to actually go into something today that most people don't know. The pullback today is not actually related to software. We're going to talk about what it is related to, and very few people are understanding or talking about it. And I think you're going to get a lot of value once you understand what we're going to lay out. But first and foremost, the put-call ratio. This probably shot over higher levels today, so you want to be looking for probably a bounce back in coming days from these levels. You can see here, we're not totally overbought on some of these regular index, like the NASDAQ is actually looking closer to a point where it's going to bounce versus collapse. So there's some selective opportunities. I mean, we were in the market pretty darn aggressively on PayPal the last few days. Our basis is now came down from 59.60 to low 55s, and we hope to get it down to 53 before this sell-off is done. That's going to take some work, but we think we can get it there. NASDAQ up, down, on balance volume indicator. Again, this is closer to the levels where you want to start to be looking at to what to buy versus what to sell, even though the indices haven't collapsed much. A lot of damage under the surface to software and AI-related names, which we mostly avoided and came out the gate with a super, super strong January and February. Today's I've had more fun days than today, but all in, very, very pleased with where we are year to date. Real estate coming off the mat. This is going to go higher. Rates are going to come lower. That's part of what I'm going to talk about as it relates to what's going on with the market in a bit. Here's healthcare. Still huge opportunity to be a buyer, not a seller, based on where this index is. This is the healthcare stocks above the 20-day exponential moving average. Dow intermediate term breadth momentum again. The Dow hit 50,000. It's obviously pulled back a bit off of that, but it's not showing that it's really excessively elevated here yet. So I think this is more of a fake out than anything else in the short term. We're not really dramatically concerned with the short term. We just want to know when to be buyers and when to be sellers. And we were buying stuff in the last 48 hours for sure. NASDAQ intermediate term volume momentum oscillator again. This looks like it actually wants to get ready to bounce. Maybe not Friday going into the weekend, but probably Monday, Tuesday. Dow, as much as the Dow's gone up and the Main Street names are flying, which is what we're concentrated in predominantly. This is not yet extended. Same as PMO by SPX, percentage of companies on a PMO crossover buy signals. These are just barometers that we use to get a sense, like when the market is shaking out, is it time to buy stuff? Is it time to wait? Are we near the top? Are we near the bottom of extreme on these things? And you could see, not so much from looking at the indices, but looking at individual names, some of these software stocks have been taken out to the woodshed and shot. That doesn't mean they're going to bounce right away, but there are going to be some that get pretty attractive. Same with the NASDAQ McClellan oscillator, again, towards the bottom, not a top. Summation index seems like it has more room to move to the upside. Advanced decline index. Yeah, our general base case is the markets are going to be, sideways to up, probably peak in April, early May, and then be very weak, a lot weaker into the election. So some of our staples will do very well. Some of our defensive, some of our healthcares will do really well during those periods. And then we'll also be raising cash from that to be prepared to pounce on probably tech in the fall if we get a lot of weakness in the general indices before a year-end recovery. So we're looking forward to that, and we'll be preparing for that in the next 2 months as the markets probably creep higher, break through 7,000 on the S&P 500, and break through, again, 50,000 plus on the Dow. NYSE McClellan Summation Index, again, not really at peak levels. I think we're going to push through there, get through that 7,000 in the next couple of months. Skew, option skew, this is the cost to insure against one standard deviation moves, call it 10%. Basically, the price to buy puts 10% out of the money. If you want to really simplify it, it's not a perfect definition. And it's come down a little bit. So when you want to be more concerned is when it's super duper elevated, because that's kind of the smart money buying protection before the fire. Right now, they're not buying a ton of protection here. So that's that. This is more on an uptrend than a downtrend, whatever credence you give to that. VIX spiked a little today, so maybe another day of follow through on that, and then we should get some ease. As it relates to PayPal, show me the incentive, I will show you the outcome. That's Charlie Munger. Well, as we look at Enrique Lore's pay package, you can see that his incentives are aligned with ours, and that is to get the stock to $125 per share within the next 3 to 5 years. And you can read this at regarding the RSUs and the PSUs in their public filings. He gets a bunch when the stock gets over basically $80, and then he gets a bunch more over $100, and then he gets a bunch more over $125. So the incentives are aligned. The other thing I want to keep you guys to keep in mind is the magic of buybacks. And the magic really starts to happen is after they buy in 50% of the stock. So they've already bought in about 25% of the company, I think 1.25 billion down to 950 million. So they'll get to 50% of the shares bought in the next, 3 years. But once you start to get to 80% is where the magic happens. So this is the return without a change in earnings or PE multiple. Now, it's very hard to not get a re-rating and the multiple not to go up when earnings are going up. And that's going to be a function of the share count shrinking and actually executing properly like you did with HPQ. But when you start to, so if he buys in 67% of the stock, you get an automatic triple bagger. That's with, again, these are without changes in earnings. You got to just bet, 2 weeks ago, we did the article on PayPal and we overlaid the PayPal stock chart with, actually, I'll pull it up. We by the way, while you're at hedgefundtips.com, click on terms. All of this is opinion, not advice, as always. But we overlaid PayPal with the consumer sentiment, which is at multi-decade lows. Last week, there was a print that just was the highest in 6 months. But as you can see, stock price goes with this. So if you're betting against inflation, so just on inflation, they're going to do more volume and earnings are going to go up in nominal terms. And then as this starts to recover, just like it did in 2000, and so we haven't seen sentiment this bad since 2009, and then the double dip in 2011. Here we are in COVID, and then again in last year. It always invariably recovers. And when it recovers, PayPal does exceptionally well because PayPal has a lot of operating leverage tied to consumer spending. But let's assume nothing good happens, okay? And he just follows through with the $6 billion of cash, no earnings growth, buying in 15, 20% of the stock every single year. He's effectively knocking on the door to 50% in the next 2 years. Then you wind up with 67%, which would be 3 years. Again, no earnings growth, no improvement in the business, no inflation, no consumer rebound. You have a 3-bagger, okay, from these levels. So now you're at 120. Then if you wind up going up another year, you wind up with a 5-bagger just from buybacks, with no improvement in earnings, no multiple re-rating in PE multiple, and so on and so forth. It really gets magical after 80%. Robust earnings growth and multiple expansion deliver huge home runs, and that's what's going to be taking place. So while everyone's dumping, we were buying every single day. Our fingers are definitely bleeding. It is our largest position, and we're super excited. And it's going to take more than 5 minutes, but I think most of the pain is in the rearview mirror. The same thing happened when Enrique took the helm, was announced CEO of Hewlett-Packard the month before. The stock collapsed down to $10, and within a few years, he bought back 37% of the stock. It peaked at $37. Now, if they were pigs and they held on after 3.5 bagger in a few years, then, shame on them. But we don't make that mistake. So, as you know, whether you've seen it with Albemarle selling at the right time, Vornado selling at the right time, 3M selling at the right time, et cetera, et cetera, et cetera. It goes on and on and on. So next thing, people are saying, got to ask me anything question. Are you worried about Papa John's debt schedule? No, because we actually burden ourselves with the facts. So none of Papa John's debt matures until 2029, then 2030 and 2030. They've got ample operating cash flow of 160 million, ample free cash flow, cash on hand. The leverage ratio is 2 turns lower than it needs to be. They're going to be fine. So what's been happening in the market? Why did we have such an abrupt sell-off? And why was it concentrated around 11:30 a.m. Eastern, which is when you always see the close of trading in Europe is where you get a tremendous amount of pressure. There are 2 pressure points in the trading day in the US. One is 11:30 when the Europeans are selling, when the markets are tumultuous. And one is 2:30 when the margin clerks are calling on all the Robinhood accounts to pay up or liquidate their stocks. So what we saw was a tremendous amount of pressure late in the morning. And everyone's trying to find the headline, like what software stock is blowing up. It's not that. It's about the EU. Okay, their situation has come to a critical point where they're debating Eurobonds, which is exactly what you saw back in 2011 when they almost blew up. Joint debt for strategic investment in defense, green tech, and AI, with France pushing for them and Germany, Netherlands opposing due to fiscal concerns, though the EU has used joint borrowing for the COVID recovery fund, the NGEU, and Ukraine loans, moving towards a more common debt instrument despite political hurdles for full Eurobonds. Okay, so this guy, Brian Rich, had really good commentary on this. And what he's talking about is in 3 months, when Warsh becomes the Fed chair, the 15-year era of global central bank coordination, where the Fed implicitly backstopped the world via unlimited access to US dollar liquidity, is likely over. Okay, so now they've got to fend for themselves. Access to dollars becomes Trump's leverage to influence change in Europe, and without friendly Fed coordination, Europe becomes exposed to another sovereign debt crisis, which is an existential threat to Brussels, as they are facing trillions of euros in new spending commitments. So the EU leaders are scrambling. They met today to game plan a way to self-fund their big spending needs, defense, AI, and energy, and shore up confidence in liquidity access. Obviously, they failed. And to have a chance at making it work, they will need unification. They need to finance on the full strength of Europe, aka on the back of Germany and the Netherlands, the fiscally responsible nations, a Eurobond. They need a fiscal union, and they will be consulting 2 former Italian prime ministers that have mapped this out. Mario Draghi, who just wrote a 400-page paper, also former head of the ECB, and Enrico Letta. Both have been vocal in calling for common EU debt and integrated capital markets as necessary for survival of the euro. That will be the presentation that happened today. But as we saw in the markets, they have a problem. They need a unanimous vote by law. And that's where it gets interesting. And that's why you're seeing a lot of turmoil in the market, not because Baxter had weak guidance for 1 quarter, although they had record revenue. We'll be covering that one in coming weeks. Not terribly worried about that, especially because it ran up so much into earnings. Both have been vocal in calling for common EU debt and integrated capital markets as necessary for the survival of the euro. That will be the pitch tomorrow. Blah, blah, blah. So here's where it gets interesting. Draghi saved the euro in 2012 as ECB president by ripping up the rule book. The Maastricht Treaty said no bailouts. He found a loophole and did it anyway. In the current situation, under unanimity rules, a single country can veto legislation, in this case, the idea of common debt issuance, and that's where Germany and the Netherlands are standing. But Draghi and Letta have a workaround plan, ripping up the rule book to require only a qualified majority. That could mean integration in Europe is coming, or disintegration. So today, the short-term voting machine was disintegration. I think in coming days, we're going to find that they move towards integration because they have to survive. So that's the story there. Stiefel out on Cooper Standard. Expectations for earnings from a demand perspective. We expect investors to be focused on the potential customer supply chain disruptions and any impact on the outlook for demand in its own business, including catch-up production by Ford in first half 2026. Reshoring of production by customers from Mexico to the U.S. could create share gain opportunities for Cooper Standard. We'll be looking for updates on opportunities the company sees after announcing 2030 targets last quarter that implied significant differentiated growth and margin expansion over the next 5 years. We will be looking for more details on progress and any additional content wins. Management has noted that progress to 2030 targets should be relatively linear, and we will be looking for 2026 guidance to reflect that linearity to increase confidence in targets. Let's pull up some Slumer charts. You can see here, this is the S&P was knocking on the door to 7,000. It was rejected down to this level today, 6,800 and change. So we'll see if it holds or we have to go back down to 6,780 before we bounce back up. We'll know in the next 2 days. 10-year yield is coming down. This is going to go all the way back under 4 again this year. As we get closer to Warsh stepping in. Warsh's game book is going to be to shrink the balance sheet again. So he will be sopping up liquidity by selling bonds in the open market. That's bearish. That's hawkish. But that should give him latitude to do what President Trump wants him to do, which is lower rates a lot. So if he sops up a lot of liquidity and is hawkish with the balance sheet, that will enable him to bring short rates down dramatically more than they would be able to otherwise, which might actually work. And then if you have the Treasury helping, issuing on the short end and buying on the long end, you could have a situation where that 10-year gets down to 350 and housing goes through the roof in terms of demand and supply. And I think that'll be very, very constructive. So stay tuned on that front, but it's got a lot of implications that the market's trying to figure out. I think you're going to see TLT go a lot higher, which is long bond ETF. I think you're going to see, here's the real estate index starting to break out from a downtrend. Here's software. It looks like it wants to find support here. I think there's some opportunity there. Both software and financials were hit on AI worries this week. So it was a double whammy for PayPal, which gave us the opportunity to buy up our share of $6 billion of free cash flow at dramatic discounts. So we're super excited about that. And we'll continue to be in the market doing that and hope to get our basis down to $53. So when it's 150, we make a triple. And then on the options that we've been able to start to put in place, get some 7, 8, 9 baggers on top of it. Software index looks like it wants to kind of find some support here. There will be some opportunities there. Let's look at the second Slumer. Thanks to our buddies over at RBC. And that just kind of shows the long-term view. It was knocking up against that resistance. Not yet fully overbought. So I could see a situation where it goes up to 7,500 before it really bounces back down, which would be actually an ideal situation. We jam up to 7,500 late April, early May. Everyone gets super duper excited. And then you got to just harvest profits, sit on some cash, wait for weakness into the fall, and then pounce and ride it into year end is our general roadmap at the moment. We're not really overbought yet. Sentiment isn't super crazy yet. So I like days like this. Midcap's breaking out, sign of health and broadening. Russell 2000, same thing. So it'll go back down, probably test 20, 25, 95 just to scare people. The Johnny come latelys who bought the breakout got smoked as always. Europe, Australasia, Israel, and the Far East breaking out. So all the international continues to break out. Emerging markets breaking out from 15 years of consolidation. This is going to be a continuous thing. Baba, Baidu, companies that benefit, that have a lot of earnings abroad, GXO, X-Ray, Dentsply, Sirona. International will continue to outperform, and small and mid. When we were saying that 12 months ago, everyone said that'll never happen. It's going to be happening not only for a year, it's going to be happening for 5 to 7 years. It's going to be like the early 2000s, which we've been talking about for a long time. 10-year yield, this will roll back over. It'll be interesting when it gets back to 359. I don't know when it will. I think it will sometime this year. Will it hold that, or will it actually work its way lower? And I think that's just going to be a function of how effective he can sop up liquidity by shrinking the balance sheet while cutting rates at the same time. 10-year yield. Dollar breaking through this. This is going to trend down for the next few years with fits and starts. Now everyone's getting bearish. Maybe we have a counter trend move. Euro's breaking out. This kind of implies to me probably get a little bit of argument about the Eurobond once they announce the Eurobond or some version of it. We're going to just continue to plow higher, which is nice. Have some land over there. So amen, hallelujah. Canadian dollar. My Canadian friends continue to get rich, continue to be skeptical and not believe it. You guys are going to be smiling so wide you could eat 3 bananas sideways. Wait till you're at 76. You're going to be coming down here buying buildings like you're rock stars. And gold, more of the same silliness until it changes. What's this? Silver, copper. Wow, copper is cranking. It's a sign of economic health, China recovery. Crude starting to move higher. That's been a base case of ours for a while, breaking out. We have our exposure there. Palantir didn't hold this level. I think it got down to 125 or 130 today. So we'll see how that continues to play out. NVIDIA been sideways for a year. Microsoft trying to find resistance. We'll see. Or does it have to go back down to the future, back to 347? We'll see. Carrier. That's interesting. Transport's breaking out. A sign of good health. This is going to be the year of Main Street, not the year of Wall Street. And we love it because we own a lot of Main Street stocks. What else do we have here? Medtronic, some of the medical device makers. Pfizer coming up against resistance. I think this thing's going to climb higher. We own a big position or synthetic position in Pfizer for the most part, which we're excited about. That's been climbing. Okay, a lot of good stuff. All right, let's get down to more data. High risk market home price trends. So a lot of markets in Florida at risk of coming down. A lot have already come down. There were, maybe we'll find the thing, but there were like Napa Valley's down. Napa is down 8% in California. There are a couple markets in California, a couple in Texas that were down almost double digits year on year. And it's usually Florida and Texas that kind of leads the country. So we'll see. The markets that were hot were the Midwest. So again, Main Street versus Wall Street. Builders have baggage land, incentives in politics. More building activity equals more materials and more distribution throughput. That's why we have QXO. That's why we have Stanley Black & Decker, et cetera. U.S. staples off to the strongest start since 1997. We love that. Look what's happened with Diageo, what's happened with Hormel, up 11.9% year to date. That is the best start since 1997. So when we were pounding the table on that in the fourth quarter on the podcast, everyone said, no way. Well, that's exactly what's starting to take place in a material way. What do we have here? Assessing software. Where are the multiples? So peak was at 17.3 times enterprise value to next 12 months sales. Now it's down to 6 times. So they're trying to make a case that it's kind of back to average. It's time to buy. I think some of them can start to bounce, but some are going to be permanently disintermediated. So good on you if you can discern what's what, but I think it's kind of a guess. And some are going to guess and they're going to write books about them, and some are going to guess and wind up as Walmart greeters in a couple of years. The index of consumer sentiment. This is a longer term picture. This is what I'm talking about when you overlay PayPal's chart to consumer sentiment. We haven't seen sentiment this bad since Volcker and then since the great financial crisis. It always recovers. It always happens to retest. We've just retested. I think it's going to go straight up. I think PayPal and consumer discretionary, like Papa John's, like VF Corp, are going to rip higher, and it's going to happen probably over the next 12 to 18 months or sooner than we expect. CapEx keeps going up for Mag 7. Margins and earnings growth rates keep going down. Earnings have been good. Packaged food and beverage sales surged during the week of January 24th, boosted by the winter storm, driven by pantry loading. One of the biggest beneficiaries of pantry loading was Hormel Foods. What do you need when it's snowing out? Apparently a ton of Spam and Planters peanuts. So we're happy for that. Staples, the top 3 performing sectors during Fed easing cycles, and the easing cycle is going to resume in June, are real estate, staples, and healthcare. That's why we are seeing that outperformance, and that will continue. Precious metals, what's this? Retail options buying in precious metals is 6.6 times normal. I guarantee you those options aren't going to be paying out. And as we get to the back half of the year, all the people chasing the literal shiny objects, not the figurative shiny objects, are going to be monkey hammered, as we say here on Hedge Fund Tips with Tom Hayes. Housing affordability is starting to peak up. Consumer staple sector is ripping higher, so it's probably due for a breather. Operating cash flows spent on CapEx versus buybacks are now through the roof. for the tech companies. And then if you look at the growth index divided by the S&P value index, it hasn't been this high since 2021. If you remember what happened to growth and tech in 2022, you're seeing the early stages of it now. That's why, it's funny. I see the support levels. I see the sentiment in software, but I also see a lot of people that want to buy the dip, which makes me think that there's going to be way more pain ahead this year for those frothy groups. And there's going to come a point like there was in October 2022 where they're just so despondent and no one wants to buy a software stock. No one wants to buy an AI name. And I do think we're mid innings, fourth or fifth inning. So that will be an opportunity to buy it for the final parabolic move when people have thrown it out 70, 75% down later in the year. And we will be happily scooping up shares when everyone says the AI trade is over and uninvestable. But for now, let them keep catching that falling knife. Momentum trade gets trashed again amid rotation to value. I mean, we were writing these headlines out last year on the podcast. Now they're actually real headlines. Consider value equities as a hedge against AI risk without sacrificing equity exposure. Opinion follows trend, ladies and gentlemen. That's one of the things that I spent time teaching the young men and women at USC yesterday. The most important 3 words I was ever taught in my career. Energy funds see second biggest weekly inflow ever, probably due for a pullback. What else we have here? You can see New World Order, U.S. exceptionalism to global rebalancing. So this is not where you want to be in the most concentrated stocks, ladies and gentlemen. So look out below, and you're seeing the early stages of that part, and you're seeing the other stocks start to rip higher, like staples, like healthcare, and that's going to persist, like international, like small caps, like mid caps, aka anything but the most crowded trades for the last few years. Earnings are coming in good. Sentiment is a little bit overbought here, and that's why we had to start to see a flush out in those crowded names. And you're going to love the talk I gave to the students next week in episode number 331. You definitely want to tune in for that. Small cap profits are at their highest level since 2021, ripping higher. And green shoots in manufacturing, we said that was going to be a catalyst. The ISM turning up, that's happening globally. Very positive for Main Street. Magnificent Mag 7 relative to unmagnificent 493 rolling over, just like you saw during that period. Small cap earnings recovery in a material way. ISM back above 50. Now what small caps have typically outperformed in the 3, 6, 12 months after ISM moves above 50. Early stages. Here's another look at consumer sentiment and what happens to the market next, and good things happen for those type of companies that we've been talking about. Here it talks about the long-term cycle of the US dollar. We've been talking about this for a year to get ready. Well, it's starting, and people say, well, now we're due for a bounce. You might get a counter trend bounce, but this is going to be a 2-3 year trend, and it has nothing to do necessarily with policy. It's just a normal cycle. It's coincident versus causal is what I should say. This has been building up for a while. Prime book, U.S. single stocks, positive value is increased shorting. Growth tracker flags recovery. Revenue growth is healthy. Stock price index relative total return of technology sector. So you can see technology rolling over relative to the rest of the stocks in a material way. Percentage stocks at 52-week highs. Return 6 months later on average up 8.6%, but 2 weeks later down 40 basis points. China passenger travel way up. Active share dropping as long only's forced into mega caps over the past few years, so now they're getting liquidated. Hedge funds exposure to cyclicals still low, but has swung higher. So opinion will follow trend. That will be the next bid in the market for those unloved groups that we're benefiting from. DXY with dollar positioning. Hard data is strong. Sentiment may be finally catching up. That consumer sentiment is going to work on a lag basis. Again, that's the most important chart to watch, not only for PayPal, for VF Corp, for all consumer discretionary, for the restaurant basket, which there's huge opportunities there. You can see all the inflows into staples, the defensives. China stocks win most MSCI additions since May 2023. So they were getting them out of the indexes at the low. Now that they're all up double and triple, they're starting to add them back into the indexes. When they're at 4x and 5x, they'll be putting every Chinese stock in right before the next cyclical downturn. Small cap rotation in full swing. China consumer confidence, amazing to see what Baba's doing, and this hasn't even started to recover, which is super exciting because it's going to recover aggressively. We're seeing it in the Canada Gooses, we're seeing it in the Estee Lauders, and then some. Money rotating out of 2025 winners into laggards and cyclicals. Atlanta Fed GDP now estimate still right around 4%. That's Main Street once again. This is quite a sales forecast by OpenAI. They are at 3.7 billion of sales. When they went out to raise money, they said they're going to grow at 108% per year to 145 billion by 2029. Time will tell. There are a lot of debt holders that are praying for that and betting on that. Time will tell. S&P 4-year cycle for 2026. So again, this is exactly what we've been talking about, this sideways choppy volatility through March, rally into late April, and then lots of weakness into the election, which we'll take advantage of, and then a rally into year end. This is the standard pattern, and we are positioned for it. CPI trending down towards 2%. That will give Warsh a lot of room. Year-on-year earnings growth for Q4 up 13% versus 9% estimates. So the real economy is doing well. Try to get a reservation at a decent restaurant. They're packed. Equal weight outperformance. We've been talking about this by equal weight over cap weight. Look what's happened. It's 4.5%, 4.2% outperformance over the S&P 500 year to date alone. And you can see here, S&P Global Cycle Indicator stays in boom for the economy. XLK sector, short interest at record high. Might get a short-term bounce with that type of situation. Yeah, it's looking like some of this, and the NASDAQ skew is elevated. It's looking like some of this is at the point of, let's see, is the highest since the April lows. Okay. Despite fear, a large index in VIX futures. So we're probably at a short-term extreme here. More than 500 leveraged ETFs now trade in the US. What could go wrong? All right. Let's get to some of the news and then some Ask Me Anything questions. Alibaba's Quen tops 120 million orders in 6 days amid China's AI shopping battle. China's Alibaba launches AI model to power robots as tech giants talk up physical AI. Joe Tsai on the future of open source AI, why full stack companies will excel. China digital exports surge as Alibaba, Tencent lead global push. Wall Street gets on board with the hype over China AI stocks. Opinion follows trend. They're now starting to upgrade them and get on board. Goldman, JP Morgan, Morgan Stanley, who was the one downgrading Alibaba at $60, upgrading it when it was $300. Jack Ma backed Ant bets on AI health in $69 billion sector race. QXO to buy Kodiak building for $2.25 billion. Brad Jacobs, the moneymaker, has done his second deal already with QXO, and we are benefiting like crazy. Very grateful for Mr. Jacobs doing that for our clients. Moving along. Exclusive GXO, Patrick Kelleher, who we had on the podcast on AI, M&A, and why the company is not for sale. If you remember, I went livid when the board was entertaining a $60 per share takeover, and I called and said, I did not get in this company for a 20% return. You are stealing $40 of upside at least from me. Run the business, and that's exactly what they're doing, and they're doing it in an incredible way, and they're going to be a triple-digit stock and beyond. Patrick Kelleher is a winner, and Brad Jacobs strikes again with success for his shareholders. Home generator maker is shifting focus to AI data centers, and the stock is soaring. I like this story, but this reminds me of when Albemarle hit $164 and we took our 3x or almost 3x, 2.5x very, very quickly, because the narrative shifted from lithium for EVs to lithium for robots, and the hype then took it after we sold, went up to 190. Now it's back to 160. So I like that they're playing the AI game, and I think there's a lot of runway with what they're doing because they are a key player in that. But we're going to watch and see how much legs this new narrative has, and if it gets insanely frothy and excessively over fully valued in the near term, we will take advantage of it. Electricity demand is surging. The grid isn't ready. Comstock will be ready with all the natural gas you want, and we will be smiling so wide we could eat a banana sideways. Boeing mapping plans to hike 737 jet production to record rate. We love that. How much is priced in? Not all of it. There's still some upside, but the IRRs are going to start to wane as we get closer and closer to 300. Imagine just a short while ago, people were dumping it to us at 135, 140, 145. They couldn't get rid of it fast enough. The doors were falling off the planes. At 300, everyone's going to want it, and we're going to have to start helping them out. India is reportedly ready to buy up to $80 billion in Boeing aircraft following the trade deal with the U.S. So a year and a half ago, every day, Boeing was getting sued. People were falling out of planes. Doors were falling off. Everything was bad. And today, you can't find a bad headline on Boeing. If anything, now the bad headlines are on Airbus, and Boeing is the favorite child once again. So how sentiment changes as price changes. PayPal at crossroads with another CEO hired for turnaround. So they go through the optionality they have with spinning things and selling things. The key thing here is when you have free cash flow, when you have a healthy balance sheet, when you have a lot of good pieces, you have what we call outs. For those of you who play poker, outs means you have a lot of ways where you can lose and still win. And that's exactly what we see here with PayPal. Enrique's going to run his playbook that he ran at HPQ. I think he's going to have a lot more tailwind than he had at HPQ, and he's going to get even better outcomes. Walt Disney CEO roller coaster, why Josh D'Amaro can smooth the ride. We agree. He's investing in the high return on capital businesses. This one will be fine. Why Diageo slump is an opportunity for investors. This was written a week ago. Now the stock is up $10 ever since. We continue to like this one. Baxter annual profit forecast disappoints as key product Trumple's mount. So look, they did record revenues. The turnaround in the Novum IQ pump is not happening as fast as we want it to. We're very comfortable at these levels. It ran up like $4, I think, into earnings. So it's giving back half of that. We're comfortable with that. We'll probably nibble at it in the next few days. U.S. Energy Secretary seeks flood of investment in Venezuela. National Oil, well, Varco should benefit. U.S. is awash in natural gas, but American factories still can't get enough. Amen, hallelujah. Let's build the pipelines and let's help Comstock. Revenge of Real, why energy materials and staple stocks are beating the market. Tomorrow's headlines today at Hedge Fund Tips with Tom Hayes. Just go back and listen to any of our podcasts 6 months ago, and you knew this was coming, and you've benefited from it dearly. Share of U.S. firms reporting earnings growth hits 4-year high. We covered this with Ash Webster on Fox Business. Trump says Fed pick wash can get economy to hit 15% growth. Ahead of midterm elections. Okay. I'd take the under, but still. Sector rotation is picking up. Tech still dominates the S&P 500, which is why I think the index returns are going to be subdued, and we're going to make a lot of money under the surface by the end of this year. Tech AI spending may approach $700 billion this year, but the blow to cash raises red flags. Forward planning, 5 models under $40,000 in affordability push. Remember when we got involved at Cooper Standard at just over $5 in May of 2022? Now it's $35. We said the number one predictor of volumes, which is where we make our money, is affordability, aka incentives. Tell me what incentives do. I'll tell you what volumes are going to do. Tell me what volumes are going to do. I'll tell you what Cooper Standard earnings are going to do. It's all coming into play. Ford aluminum supplier expects fire damage plant to be repaired in June. And high-end healing stock market and sentiment results. Estee Lauder, ho-hum, another beat and raise quarter from the global leader in prestige beauty. Another one no one wanted, $50, $60. Everyone's starting to get interested at $120, which means we had to get a correction back to $100. All of the key building blocks for the Estee Lauder turnaround were on full display in the second quarter. Organic growth accelerated 3.8%, putting Estee Lauder firmly on track for its first year of positive organic growth in 4 years. Mainland China further accelerated to 13% organic growth from plus 9% last quarter, with Estee Lauder gaining prestige share for the 4th straight quarter as the Chinese consumer recovery moves off the mat. The shift into high growth channels like Amazon and TikTok Shop continued to pay off, driving high single-digit online organic growth in the first half and putting online sales on track to exceed the prior record of 31% of revenue, a key driver behind Estee Lauder's return to volume-driven share gains in the U.S. after more than a decade of losses. Most importantly, top-line acceleration is translating into margin recovery as PRGP benefits begin to flow through. Adjusted gross margin expanded 40 basis points to 76.5%, while the number one metric of the turnaround, adjusted operating margin, jumped 290 basis points to 14.4%, reminding us of what operating leverage looks like in real time. Just like the organic sales recovery, this puts Estee Lauder on track to expand operating margins for the first time in 4 years as the company works its way back towards its historical mid-teens margin profile over time. If there were any question marks about where the turnaround stood heading into this report, these results answered them. Last year marked the clear inflection point for Estee Lauder, with the worst now firmly in the rearview mirror. Of course, expectations were already sky high coming into the report. After a 190% rally off the April lows, with a strong holiday season in both US and China already baked in, investors were looking for any excuse to book profits, and the post-earnings sell-off reflected that reality. That's fine by us because, let's be clear, this was an expectations problem, not a fundamentals problem. There was nothing in this report that undermines the long-term turnaround story. In fact, everything we care about, whether it's China's recovery, U.S. stabilization, digital push, margin expansion, free cash flow, continued to accelerate and looked even better. Selling here is a simple case of missing the forest for the trees. Estee Lauder turnaround is like a giant cruise ship, Disney, of course, doing a U-turn as opposed to a speedboat doing a dime. It takes time to cut costs, clean up operations, and reaccelerate growth. But once it finishes the turn and the business gains momentum, there is no stopping it. That's exactly where we sit right now. And the same people that sold the stock last week will be chasing it again when it has a 2 handle in front of it. Rather than getting cute and reacting to short-term price fluctuations, we are perfectly content to sit on our hands and wait as we have a much lower basis. Wow. Super low basis. Okay, we continue to see this as still the very early innings of a turnaround at one of the highest quality franchises across the globe. We captured the bargain when we bought it, marked down when no one wanted it. Now we let time, fundamentals, and execution do the heavy lifting as Estee Lauder reminds the market why it remains the best in the business. So we've circled and highlighted all the key points. We put stars you definitely want to go to hedgefundtips.com and read it. You'll find it right here on the right side in the most popular posts, or you can just find all of our articles in commentary, all of our videocasts under VideoCast. And the top 10 reasons, you can go through top key points of what happened with earnings. You want to read through that there as well. Moving along to Canada Goose. The goose is loose. And let's take a look. Canada Goose is another one of our leverage plays on the luxury cycle turning and the recovery in the Chinese consumer. Just like Estee Lauder, this recovery was front and center in Canada Goose's most important holiday quarter. Revenue accelerated 14.2% to fresh record highs of $694.5 million, with its two largest markets, the US and China, posting 23.3% and 13.1% growth, respectively. Direct-to-consumer comp sales accelerated 6.3%, making the fourth straight quarter of positive comps, led by high single-digit gains in mainland China and North America. A major driver of this top-line recovery and a core pillar of the turnaround is repositioning Canada Goose as more than just a $1,000 plus parka brand. The company is transforming from a winter-only one-time purchase item to an all-season 365-day relevant luxury lifestyle brand. Sweaters, t-shirts, sunglasses, shoes, you name it. The iconic North Pole patch is now on it. In this all-important third quarter, revenue from these newer categories more than doubled year on year, with products outside traditional heavy down-filled outerwear now representing 50% of sales. This deliberate mix shift away from ultra-high margin parkas comes with some gross margin trade-off, contributing to a 40 basis points contraction to 74%, even as the company continues leaning toward higher margin DTC, which reached 85% of sales in the quarter and away from wholesale. In our view, making this trade-off is a no-brainer. By the way, it's a very similar story to PayPal. People were worried about the margins because the Braintree had lower margins than branded checkout, but their free cash flow kept growing. And that's the name of the game. You give money into an investment because you expect a lot more money down the road, whether that's, tremendously more revenues with slightly lower margins or flat revenues with margins increasing. The key is, how much cash do you get back from the cash that you give out? And that's the name of the game. And what we're seeing here is it's plenty in both cases. So where Goose did face pressure and what the market clearly wasn't a fan of was the EBIT margins and the failure to drive strong operating leverage in what should have been a blockbuster holiday period that otherwise beat expectations. Adjusted EBIT margin stepped back to 29.3% from 33.8% last year. A large amount of the contraction traced to two one-time items: a $15 million bad debt provision tied to a U.S. wholesale partner and a $9 million FX gain from last year that didn't repeat. Adjusting for those, there was still 150 basis points of underlying compression driven by higher labor costs and stepped up marketing spend. The good news is that management made it very clear that restoring strong EBIT margins is a top priority, with no structural reasons in the model preventing strong flow-through and a return to historical levels. They expect material margin expansion starting in fiscal year 2027, driven by several key building blocks: reducing marketing as a percentage of revenue, rolling out a new store labor system, optimizing the store footprint, targeted price increases, and continued broad-based revenue growth driving leverage. The market is clearly taking the under, treating the stock as a show-me story. With the jury still out, converting top-line momentum into bottom-line expansion, we are happy to take the other side of the trade, with top-line demand reaccelerating and all signs pointing to the early innings of a luxury cycle turning. Goose is no longer fighting the current. At this stage, it largely comes down to execution. What gives us real confidence in that execution is CEO Danny Reese, the third-generation leader and grandson of the founder who has been running the show for the past 25 years. When he took over in 2001, annual sales were around $3 million. In fiscal year 25, they hit $1.35 billion. With that track record and massive skin in the game, over 20% of the shares outstanding, we couldn't bet against him. We wouldn't bet against him delivering. Just like Estee Lauder, and rather than paying attention to the market's knee-jerk reaction to the margin noise, we are happy to sit on our hands and let time and execution do the work as Canada Goose builds out its full potential. As we always like to say, in business, massive action equals massive results. In investing, massive inaction equals massive results, which is why so many incredible entrepreneurs and business builders who create tremendous wealth are horrible investors. It's not because they're not smart, they're brilliant. They actually created incredible enterprises. The smartest ones of them delegate to people who are great at massive inaction with a great framework to buy good businesses at great prices and do turnaround Tom specials. So with that said, the 10 points you can find at hedgefundtips.com. We are still closed to the $1 million accounts intra-quarter. That will not open until April. The larger $5 million and $10 million accounts can come in any time, as always, for bespoke service, not a solicitation. Industrials, top 30 weights, earnings power the last 60 days. By the way, if there was ever a time to be getting money to work with PayPal at $40, it would be now. Hint, hint to family offices. Cumulative 26 earnings power of these top 30 stocks was revised down by 93 basis points in the last 60 days. That's de minimis. XOP, exploration and production, was revised down 894. We don't have any E&P names. We have servicers and we have natural gas play with Comstock, which in theory is E&P, but it's gas based and it's in the sweet spot of what's going to be in massive demand in coming years. And we're up 2.5x on it already. So, and just getting started. Unemployment rate came down. A lot of health in the real economy, ladies and gentlemen. If you're in all the crowded trades, you don't feel like there's a lot of health anywhere, but all the real businesses are doing really, really well right now. Earnings growth up 13% relative to expectations of 8.3%. So that's positive. Estimates keep going up. Let's get through some Ask Me Anything questions, and then we're going to leave it till next week. You don't want to miss next week. It's going to be awesome. You're going to see my talk to the great students. Thank you to Professor Shepard for having me. All right. So this person's asking about Baxter. We're not worried about that. Let's do it here. Core thesis remains intact. Temporary headwinds continue to pressure near-term results and are taking longer to resolve than the market expects. Novum IQ ship hold now expected to extend through fiscal year 2026. Ongoing IV solutions weakness continues, both weighing on MPT, largest and highest margin sentiment. Free cash flow is still strong, which is all we care about at $438 million for fiscal year 2025. The free cash flow of Baxter was up 17.4% year on year, and they're selling it down, and we are taking advantage. Provides runway to clean up operational headwinds. Free cash flow is the name of the game in any turnaround situation, says Turnaround Tom. All right, on to the next. Okay, so your thesis is right. PayPal is super cheap, which is why we're buying it. Your numbers are wrong, but you got the general concept. Felix Og. Oh, I was wondering if we'd get any questions on Baxter today. So there you go. We'll do it in detail, I think, in 2 weeks. Next week, we're going to do a Brad Jacobs week with QXO and GXO, which have been rock stars. Jacques Palm wanted to ask about Snap. My friends told me it was a dumb question, but it doesn't hurt to ask. Your friends were right. On to the next. That guy keeps diluting the hell out of his owners and paying himself in stock-based comp. It's what we call in New Jersey a scumbag that has no respect for its owners. And hard pass. Look, congrats to him. He built a great business, deserves to be rich. But if he keeps screwing his owners, I can't endorse the stock. ATKR, let's do a quick look at this one. And any ones we missed this week, we'll make sure we get to next week. ATKR. I think you're probably I think you might be a little early on this one. It's going to take a while to rebuild a shareholder base, but let's see. Yeah, free cash flow is still trending down. Revenue is still trending down. I'd hold off on this for now because this is a broken momentum stock. This was basically a 15 bagger and it's cracked. So it's going to take a while to rebuild these shareholder base. I want to see a recovery in free cash flow first, and it's just not there yet. JT Terry. Thanks for everything you do. Adobe, no idea. I don't know if that moat is going to be breached or not. I'd probably say no, but I can't guarantee it. And I wouldn't put 100% of my net worth to buy 100% of the company. And therefore, I won't buy one share. Great seeing. You can guess and be right or guess and be wrong, but it is what it is. SJM, Smucker, that's a defensive, probably good. It's already started to move off the lows. I think you're okay with this one, but I think there are higher and better uses of your cash. But you're not really going to get too hurt with this one. I just don't see the growth story because it's not down enough. Pizza, Papa John says, does debt concern you? No, because none of it actually matures until 2029 and 2030. Josh Gallman, huge fan. Thoughts on Zeta? AI marketing? I don't think it has a moat. I think you're saying it has a moat. I don't like, how do you define that in AI? It's like an AI company that can be disintermediated by AI. The numbers seem to show that it has a moat. Let's take a look. What do they do? Omni-channel, data-driven cloud platform, consumer intelligence, like I don't know how you say that it has a moat. Like I don't know how we just avoid software stocks. So let's just leave it at that. You might be right. Lee Foster, Kraft Heinz possibly ditching the demerger, going for growth. I don't have my mind on it, but I think that the new investment managers at Berkshire selling in the hole are an embarrassment. So that's my only opinion. I'm not long or short, but if I had owned it for 10 years and took all that pain, this is not the time I would be selling it. And it just shows that Berkshire post Warren Buffett is going to be much different. DGNX, no interest. Negative free cash flow, hard pass. Marcus Baum, see an opportunity for PayPal to monetize all the data? Yes, obviously. Good point. Almas Abdarazak, Nomad Frozen Foods in Europe. NOMD. It's just been flat. Margins are compressing. Stocks down a little bit. This looks like a good trade. Maybe you get 60, 70%. I just don't see the growth reacceleration. Margins are compressing. It's definitely worth doing work, and I think it's going to work as a trade. It's not something that we'd want to own a lot of, but I think you're on the right track with that. It's kind of defensive, and it's down a bit. MGPI, another defensive. I think that's going to be fine. No turnaround in revenues, though. This is probably like Darling Ingredients and IFF. They've all been hit pretty hard. This one looks kind of interesting, actually. Let's see. Revenues quarterly. Free cash flow fiscal year. This one probably warrants further analysis. I think it's kind of setting up to get a bounce here, and it's in a defensive industry, trading at 11 times earnings, 8 times enterprise value to EBITDA. Balance sheet looks okay. And what is free cash flow doing? Yeah. What about share count? Share count's growing a little bit. I think you're okay here. I kind of like this one, actually. That one's worth more work, to be honest with you. MGPI. Good job, Dan. Matthias Mule, WPP. Is that the advertising one? I hate that business. But the stock does look ready to bounce. That's for sure. Let's see. Yeah, revenues and cash flow have been kind of flat. Super low multiple because it feels like it's going to be disintermediated. There's a creative transformation, commerce technology services, global integrated agencies, public relations, and specialist agencies. I really don't like the business. So they just named themselves something other than they were, which is an advertising agency. But it does look very cyclical, and I think this is the time in the cycle to buy it. So I'm going to reluctantly say yes and good work. Lucas Trendgrove, Moody's, MCO. Let's take a look. This has been one of the great businesses for a while. Now people think with AI, their rating services are not going to be worth it. You're not going to get a double. This is not down enough relative to where we would be interested. This is a great business at a good price. We like good businesses at great prices. You rarely get great businesses at great prices. Thanks for giving us so much. In other words, it's not going to meet our IRR hurdle. Great value, becoming very popular in the UK. Umicore, UMI. UMI.L. All right, I'm going to have to get to a school interview for my daughter. So we are going to cut it off here and pick up the rest next week when we unveil the full framework that we unveiled for the great students of USC Marshall School of Business. This one's a pass for us. So with that said, I want to thank everyone for tuning in. We'll be back next week. Same place, probably different day. In the meantime, make it a great one. Bye for now. Pause your video player to review our terms and disclaimer. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Great Hill Capital LLC or PPI is not under any obligation to update or keep current the information contained herein. Great Hill Capital LLC or PPI and its respective officers and associates or clients may have an interest in the securities, derivatives, or entities referred to in this material. Great Hill Capital LLC or PPI accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.